everybody, Matt Faircloth here. Welcome to the DeRosa Insiders live show. If you want to learn more about DeRosa Group, go to derosagroup.com, and please enjoy this program that is dedicated to help you learn all about the real estate investing business so that you can take your real estate investing activities to the next level. Let's get into the show. On to our guest. If you guys want to get into the multifamily world, there's plenty of folks that are out there that have access to dollars that they can originate for you as a loan officer. We get cold called all the time for loan originators. So it's not hard to find one, but it's very hard to find one that knows the market and that has been around for a while and has great connections and works with a lot of high-end people and has originated probably billions of dollars worth of loan transactions in his career in the loan origination space. So I want you guys to spend a little bit of time today, pop in some questions if you have them for my guest for today's program, Mark Jeffries. Mark, how are you today, bud?
Doing great. Yourself?
Good to see you, man. Good to see you. Let's introduce yourself to our listeners first.
Yeah, appreciate that. Mark Jeffries. I work for a company called Northmarq. We're an agency lender, Fannie, Freddie, HUD. We're also a big life company, servicer, originator, one of the largest in the country. And then we do and delve into every kind of capital source that's out there for transitional bridge debt, construction debt, equity, pretty much anything under the sun. I deal with banks and credit unions when the need arises, but we try to be a one-stop mortgage banking solution for multifamily. Yeah, agency is always the preferred solution for most deals, but doesn't always work, especially these days in this, what I would describe as a bit of a challenging market.
Probably see a lot of people coming to you looking to refi. For people buying assets, buying new things, right? What's working? What's penciling out now on new deals? You can't see nothing, right? Something's got to be closing. I get it's probably less volume, but what are you seeing that's penciling out now for new deals?
Yeah, so on acquisitions, it depends. What I would say is, and you guys saw a little bit of this, the last deal that we did, you guys had bought a newly built multifamily deal.
Yeah.
And right now with where cap rates are, better than what they were a few years ago, but still fairly low relative to the cost of debt, I would say. On newer properties, I would say it's a mix of agencies and life companies. Life companies are winning more of those deals because the best pricing that you get from the agencies is where you have what they call mission driven affordability.
Mm-hmm.
And that tends to be on older deals, say 60s, 70s, 80s construction, maybe even a little bit newer than that, but where the rents tend to fall below 80% of AMI. When you have a newer deal or a newer built deal, usually you're going to be 100 AMI or even higher than that. And the rates aren't as attractive with Fannie and Freddie at that point. And so some of these life insurance companies will come in, get to similar leverage in those cases, but better rates. And so the life companies are winning more business than they used to because of that. And a lot of it is that they can get to maybe not all the way to the same leverage as Fannie and Freddie, but close. But I would say still on the older vintage properties that people are acquiring, they're either using bank debt or credit unions for the more flexible short-term prepay. And because bridge loan rates, the same type of bridge debt that we were, that was 3.5%, 4% in 21 and 22, that debt's 7, 8, 9% these days. So if you can just borrow from a credit union, say with no prepay, and get reasonable leverage, 70, 75% of purchase price, but have the flexibility to bounce out of that loan when you're ready, people will do that. But if it's just a steady deal that's already stabilized, it's a comparison between all the capital sources, life companies, agencies, and banks and credit unions, just to see if somebody's going to really compete hard for a deal. And you really don't know until you really test the market and run it by everybody, because everybody's going to look at every market and location a little bit differently. The timing is always changing for every type of capital source. So one life company may have a huge appetite just based on their circumstances at that point in time. So you really got to test the market. But I would say the difference now, it's hard to beat the agencies at any point in the cycle, but the life companies are winning a bigger market share, particularly
There are
out
people
here.
bringing, but there are deals out there getting done that are, because you're debt yield restricted. So meaning for the listeners here, that means that you can't borrow as much money because the interest rates have gone up. And so the loans are capped based on how much debt service they can pay based on how much income they make. Are deals getting, I guess just the deals you're seeing, the buyers having to put a lot more equity in to get the deal closed. It's no longer 75-80% loan to value for existing stabilized properties. This is 60-65% loan to value. Is that still the case?
Yeah, especially now with the treasury being as high as it is.
Yeah.
Yeah, so it's a situation where Fannie and Freddie, when they're capped at 60 or 65, maybe 65 to 70 most of the time right now, because values have adjusted a little bit down on most of these deals. We've been in this higher rate environment for long enough that you've seen sellers be willing to make some deals. But yeah, if you're in a situation where, say, Fannie and Freddie get to 70% and they're at, call it a, I don't know, 5.75 rate on a deal, maybe you've got a life company that gets right there on leverage, but they're a quarter point inside on rate. Uh,
Mm-hmm.
and then you say, okay, that makes more sense. We'll do that.
Yeah.
Um, but yeah, certainly overall, the high leverage that we were seeing before is a little bit dialed back for the most part now.
Got it. Okay. So bringing it home here for somebody watching that it has learned a lot through DeRosa and through this conversation, but wants to go submitting themselves. They want to prepare themselves for getting into larger deals for the 40, 50 unit apartment complexes or north, right? They feel like they're ready for it, got some track record underneath their belt. And this could be the first time that they approach a loan officer like yourself or like Northmarq to help them place into more complex, but also very attractive debt like Fannie, Freddie, maybe HUD or Lifeco debt, right? What do you recommend that these folks have in place? What do they need to have lined up before they make that first phone call to you? Hey guys, hope you're loving this free education here on our YouTube channel. And if you guys love free stuff, I got more free stuff for you. Go to derosagroup.com/tools and you will see a bunch of free stuff that we've got out there. Everything from a superpower assessment to determine what your multifamily superpower is, all the way down to a free book on how to buy and find apartment buildings for you guys, even a free underwriting tool. It's all there. Go to derosagroup.com/tools and grab some more free stuff. Grab that link down below and let's head back to some free education on our YouTube channel.
Yeah, I would say making sure you've got a detailed real estate bio drafted, put together that really talks up your multifamily experience. And it doesn't necessarily have to be as a sponsor. It could be as a property manager. It could be as a broker. Could be as working as an analyst on a deal team, or an asset manager. But talking up your multifamily and general real estate experience as much as you can is important, because if you're a first time agency borrower or it's the first multifamily deal that you're involved with the acquisition of, you want to show that you know what you're doing is to the extent that you can. I would say the other thing that we see a lot of newer folks not necessarily putting a ton of time into is just the raw numbers and the projections for the deal that we're discussing. Really dialing in your hold period and building out your pro forma, your income and expense pro forma over the next 3, 4, 5 years that you project for that particular property. That's important. If it's a value add acquisition, having a really thoughtful CapEx plan and budget as detailed as you can is extremely helpful.
Mm-hmm.
All those things send the message that you prepared and you're serious, and makes lenders take you a lot more seriously.
Yeah. So your track record for what you've done, what you're going to do with the asset, and then a snapshot of their personal finances, where they are and their business assets, and
Right.
like a really strong PFS, put together PFS anyway. And if it's not just you guaranteeing the loan or sponsoring the loan, guys, it's whoever else you've got on your team. Maybe if an investor is joining you that's it's got a significant balance sheet that needs to step in, Mark will obviously tell you about that, but that's something that you should have all lined up in place. Guys, check out Mark Jeffries. I'm supposedly LinkedIn you too. They could look you up on LinkedIn, but find Mark Jeffries from Northmarq and any of those outlets as well. Mark, been great chatting with you. I really have enjoyed all your business support for helping DeRosa get itself to the next level and then there beyond for ourselves and for even the students in our accelerator program. I know you've worked with some of them too. I'm really grateful for all your support. So thank you for joining us today for DeRosa Insiders Live.
Thanks for having me on, Matt.
Cool. Take care.